Many, or perhaps most of us, learn about investing the hard way. We make a mistake and lose money. Dave Butler, co-CEO of Dimensional Fund Advisors, did just that. Colleagues at the brokerage firm where he worked were convinced that a stock called Boston Chicken would rise from $17 to $25. So Dave invested 80% of his entire portfolio in that single stock.
It also actually had worked on something called CanSlim, so it was in a newspaper called Investor Business Daily, and they had a system called CanSlim. So C stood for current earnings, L stood for leverage, M was momentum, and so I went this whole process of CanSlim, and I had made a decision that this Boston Chicken was going to be a great stock. So I put all my money on Boston Chicken. In those days, there wasn't an easy way to see what the actual result was the next day. But I was on a business trip in Utah. I went down to the sundry shop, found a Wall Street Journal. I scrolled down to B's, Boston Chicken, and I noticed that that $17 stock had gone to $7. I called my broker at the time, Tom, and Tom basically just said, it didn't turn out the way we thought it would.
Boston Chicken stock fell to just a few cents per share and was eventually delisted. Sensibly though, Dave saw it as a learning opportunity. In fact, losing all that money led him to question almost everything he thought he knew about investing.
When I was in business school, both undergrad and MBA, I probably took 90% of my courses were around that topic of beating the market. So we spent a lot of time on financial statement analysis. We did discounted cash flow analysis. We made a determination as to what a stock should be or should not be valued at. And then we were told that you actually would take a position in that stock. And then when that stock market figured it out and figured out that your answer was right, that you would actually make a profit. And that was the basic foundational view on investment management at the time. There's a handful of academics who were working on the other side of that question. And the question was really, do active managers add value? And so a number of academics at Chicago, Harvard, MIT were looking at that question and looking at it really robustly. And what they found when you looked at all the data on active management performance was that the active manager did not add any value above and beyond chance.
From then on, Dave resolved to stop speculating and start investing. Buying individual stocks, he decided, was very much in the former category.
Speculating is all part of our persona. We all have that behavioral itch to gamble, to go to Las Vegas, to put money into your next door neighbor's startup or your college roommate's startup. That's just part of our nature as humans. So the important part there is really making the distinction between investing and speculation. So what do you speculate on and what do you invest in? So if it's a certain part of your portfolio that you want to speculate with, you want to go to Las Vegas and have some fun, great. If you want to buy an individual stock with a small part of your portfolio, great. The important part is taking 95% of your portfolio and investing it in a proper fashion, which is really built around these simple constructs of diversification and low cost and tax efficiency. That's how you actually make your money.
So, Dave Butler no longer uses a broker, but he strongly recommends hiring a fiduciary financial advisor.
We started our business at Dimensional by working with financial advisors because when you think about the great client experience, the great investment experience for clients, that really in our mind has two components. So the first component is what Dimensional does. We are capital market experts. So we develop portfolios, we manage them properly. The second part of the equation is client expertise. And that's the intimate knowledge of the client that a financial advisor has. So that's an understanding of their risk profile. That's an understanding of their family situation. That's an understanding of the amount of money they can or can't risk. That's an understanding of the liquidity issues they might or might not have in the short term. So all of those things are well understood by the financial advisor. Dimensional handles the capital market part. We think the combination of those two then become this great investor experience for the client.
Over the last 100 years or so, the nominal return of the global equity markets before adjusting for inflation has been in the region of between 8 and 10% a year. That's not a bad return. And for Dave, one of the most important roles of an advisor is simply to keep the client invested.
The great analogy that one of my mentors used to talk about was, when you think about a hockey game and you've got probably 1 or 2 or 3 goals scored in a hockey game, if you get up out of your seat, go to get popcorn or go to the bathroom, and you miss that goal, you're going to miss a third of the action, right? If it's a three-goal game. So you have to stay in your seat. And just like in the markets have big movement days that are going to actually add a lot of value to your portfolio. You can't be out of the market. You can't behaviorally react to some news that's going to take you out of the market or put you in the market at the wrong time. You need to stay disciplined, and an advisor, a financial coach, provides that kind of discipline to the investor.
So, how do you identify a fiduciary advisor to work with? The key is to find someone you really trust.
One of the Nobel Prize winners that we've worked with through the years, Bob Merton, has an equation for trust. He says trust equals competence plus trustworthiness. And in my mind, when I think about competence, I think about experience, I think about education, I think about knowledge picked up through the years. And then when I think about trustworthiness, I think about setting expectations and then meeting those expectations on a regular basis.
To summarize, buying individual stocks is speculating, not investing. In the long run, most professional money managers underperform the market. So focus on controlling those things you can control. For example, diversify, keep costs low, and stay disciplined. Thank you to Dave Butler and to you for watching.